Welcome back to Overtime. Several Wall Street firms noting the impact of higher rates on the residential solar market. Truist recently downgrading Sunnova to hold, KeyBank and Guggenheim cutting their price targets. Shares are higher, though, on the week as rates have retreated, finished the day up 7%. But they're down more than 50% from the year's high. And Sunnova CEO John Berger joins us now on set. It's great to have you here.
Thanks for having me.
We were just talking about it. We kind of teed it up there. Higher interest rates. Has that been denting demand?
It is not. If you step back and take a look at what our business does and in the entire industry is utility rates continue to move higher. You have a very inefficient system, a socialistic system that has no competition. So the utilities keep raising rates almost no matter what for a variety of reasons, including interest rates going higher. And that, coupled with equipment, solar equipment, batteries, solar panels, inverters, coming down in price, really in a lot of cases increasingly crashing in price, really has blown out a wedge of value for the consumer and for our companies like us. And so, yes, interest rates take a little bit out of that, but the wedge keeps getting bigger as far as what you can do in terms of saving money against these utilities and higher reliability with batteries. And batteries are coming off, like I said, even further. And that's giving a lot of people that are exposed to hurricanes, typhoons, wildfires. They're like, you know, I can get a better energy service at a better price by going to companies like Sunnova.
Sounds like what you're laying out is basically a secular growth story. So then when the analysts at Truist, for example, say they note that you are continuing to take share given the strength in third-party owner financing. But they also note that the equity price response post-2Q results makes it clear that the market is no longer rewarding outsized growth while companies continue to compete in this land grab in the U.S. residential space. I mean, the fact that the stock has sold off this year, is it frustrating?
Very frustrating. From IPO just over 4 years ago, by the end of this year, if you look at our guidance, we'll have increased EBITDA 700%. So we're focused on profitability. We're focused on cash flow, and we've kept all of our cash flows, and we're generating more and more cash flow. We're focused on liquidity. We knew the market was going to get tough, and we went out and made sure we had the capital, and we're continuing to close on more capital. So when you financially perform like that over a period of time, and the stock goes below the IPO price that it was 4 years ago, that's incredibly frustrating. But it's a deep, deep discount. I mean, at this point, when you look at the discount rate, before today, it was about 14–15% discount rate on the top gross cash flows. That's insane. That's incredible in terms of an opportunity from my perspective.
How much of your top line growth is dependent on a housing market that is also being held somewhat stationary, relatively speaking, by high interest rates and low inventories? You say you've got an enormous amount of pricing power, but that doesn't necessarily mean you're going to get volume growth.
Well, in terms of the new home market, it's a very small part of our business. We have a great partnership there with Lennar. We bought a company from Lennar, but it's probably about 12% of our business. And so I am surprised at the strength of that business so far this year, but it's a very small part. So really what we're looking at, and this becomes more important if we get into more difficult times, which I personally think we are, at least a shallow recession is coming. In that when people need to figure out ways to save money on bills they have to pay. Think about the last bill you don't pay as a homeowner is the power and the water bill. Because you can't sit in the house without power, you can't sit in the house without water. You got to watch CNBC, you need power to do that, right? So when you look at what we are offering is at least on average about a 20% discount to the utility. And again, with batteries, a higher reliability. And a lot of our customers that signed up years ago, there's a good number of them that are saving 50% off what they would pay the utility because those utility rates have just skyrocketed and they continue to move up even more. California is looking for a raise of another 18% this year. Kentucky was also dealing with an 18% increase. Puerto Rico just raised the rates 21%. These are eye-popping numbers.
Okay. Yeah. And maybe that in itself drives demand. John Berger.
Absolutely.